Ladies and gentlemen, the 2012 TruePoint Annual Client Meeting is about to begin. Please welcome TruePoint's founder and CEO, Michael Chasnoff.
Thank you. Thank you. I think everybody can hear me okay. Well, I want to welcome everybody. It's a great crowd to have you here for our 5th annual client meeting. I want to first start off by thanking our clients, our guests, and friends for joining us. I know I've seen and talked to a lot of folks this evening that have traveled quite a far distance to be here, so really appreciate you coming along. There are a few people here I know that aren't so familiar with TruePoint, so I want to take a moment just to introduce ourselves. We are an employee-owned, fee-only financial advisory firm. We provide integrated wealth management services through a service called fiduciary services since 1990. And fiduciary services it's become kind of a financial jargon in the financial world, but what that really means is that in TruePoint's culture, we focus on our clients' interests solely, all the time. So no banks, no brokerage firms, no insurance companies. We're independent and want to provide consistent, independent, objective advice. I want to talk a little bit about our program today. We've got about an hour and 15 minutes in here, and then we'll go back and have cocktails in the museum's rotunda. But today's agenda is a little bit different from years past. We typically do an annual client update. But now about a third of our clients live outside of Cincinnati. So we have been producing an annual report, and many of you should have copies of those with you now, but if you didn't grab one, we have extras in the back. Be sure to grab one before you leave tonight. One note about the annual report, we've had a pretty strong 12-month period, and to that end, I'd like to thank our clients once again for your trust and confidence in our team. We really appreciate it. A little bit more about the agenda. Each year we have found a lot of success in answering your questions. Today we're going to be having Greg Vellier on hand to talk about the elections, Congress, the fiscal cliff, and even geopolitical events. So many of you will have questions. I know that we've had several coming up prior to this meeting, and we hope to answer as many as possible. You can submit a question by completing your note on the card inside your journals, and just pass them to the end of the row, and we'll have some folks from TruePoint picking those up during the program. One more note about our agenda. Following again our Q&A segment, we do want to encourage you to join us back in the museum's rotunda. We can't be outside in the courtyard. I guess it was a little too cool, and we're a little concerned it might be too cold to hang out and have drinks. But it's a great time for you to meet more of the TruePoint team, and we're looking forward to doing that this evening. Okay, at this point in time, I'd like to introduce Chris Cavanaugh from Vanguard. Chris and Vanguard have been great partners, and Vanguard has been a fabulous leader in our industry, looking out for the best interests of the consumer, and we're really pleased to have their support in bringing our guest speaker to this meeting. So at this time, Chris, I'll have you introduce our keynote speaker today.
Thank you very much, and good evening. First off, I want to thank everyone for coming out this evening. It's obviously a beautiful evening, no rain, so we ordered it that way, and glad you were able to make it out. I want to also thank the TruePoint team. Obviously, they are a phenomenal partner of ours, and we're certainly very appreciative of the relationship and also the opportunity to sponsor the speaker for this evening. A couple of things I want to mention. I think this is very important for you to understand. Vanguard does not partner with a lot of firms, and it's mainly because we have a very firm culture in how we operate and how we do business, And there's three things I want to mention off the top that are very similar between our firm and TruePoint. Number one is the fiduciary standard. If you know what that means, ultimately at the end of the day, it means that clients' issues come first. A lot of people out there in the industry will tell you that they have that as part of their mission statement, but there aren't as many that actually follow through with that. And that is a similarity both of ours and of TruePoint. Number two would be the investment philosophy. We both share an investment philosophy that is passive in nature and long-term in perspective. And then lastly, we are both firms that are cost-conscious. So not only do we look for low cost, but also high-quality investment solutions. And so there are a lot of similarities between the two firms, and therefore the alignment works very well. So we appreciate the opportunity to work with your firm and ultimately with you as clients. That being said, let me turn it over to our keynote speaker this evening. There's a lot of issues right now going on in our economy. We've got a very important election upcoming. As Michael just said, there's the fiscal cliff that is looming in the not too distant future. There's a lot of other issues, both geopolitical, as he mentioned, as well as economic. And tonight we are very pleased to have Greg Valliere here to speak to you and address a lot of those questions. Greg is a 30-year industry veteran. He is the chief political strategist with a firm known as the Potomac Research Group. They are a nonpartisan firm that advises institutional clients all over the world. You may be familiar with Greg. He's frequently on shows such as CNBC, CNN, Fox News, etc. So with that introduction, let me be proud to introduce our keynote speaker this evening, Greg Valliere.
Thank you. Thank you. Well, thank you. Well, it's really great to be here. What a wonderful room. What a wonderful museum. I thank you for inviting me. I've met a lot of you. I really think we'll try to have a good time in the next half an hour, but I'm going to talk about some serious issues. And we're all adults. We can handle it, I think. I'm going to talk about 4 issues that the markets, I think, have to worry about, most of them coming from my city. So I would ask all of you a favor at the very beginning, and that is, don't shoot the messenger. Yes, I can't sugarcoat some of these things. I'm going to talk about 4 big themes. First, how I think the central bankers and Ben Bernanke are running out of ammunition. Second, we have to talk about the fiscal cliff. It's a serious issue for all of you as investors. Third, I'm going to talk about the fact that the candidate the markets would prefer to see win is not winning right now. And I'll talk a bit about the election and why maybe Congress could get even more conservative. And then finally, I'll really cheer everybody up with a couple of comments on geopolitics, which I think is the most serious issue of all as we head into late 2012. I always say at the beginning of these talks that I come and talk to people about how Washington affects the markets, but I am not an ideologue. I don't come here as someone to tell you the right wing is correct or the left wing is correct. I don't think that's productive for you as investors. I'll give you my best analysis, my best guess based on all of the sources I have, but I am not a partisan at all. In fact, I've said for many years that I'm a cynic more than anything else, and my cynicism got reinforced earlier this year when the Washington Post had a poll out. I got up, looked at the paper, congressional approval rating at 13%. So I looked at it and I thought, well, I wonder what all my Republican friends would think. John Boehner, Mitch McConnell, Eric Cantor. Then I said, wow, 13%. I looked at it again and said, I wonder what all the Democrats would think about this, Nancy Pelosi and Harry Reid. I looked at it one more time and then I thought, what were those 13% thinking? How could anybody have a positive job approval rating of a group that is this dysfunctional? And I'll talk about the congressional gridlock in a few minutes. But let me start, as I always do, with a couple of quick comments on the economy. We can get that one out of the way pretty quickly. This is the most dovish Fed in my entire career. It's not just Ben Bernanke. It's Janet Yellen. It's Bill Dudley. It's Charlie Evans in Chicago. It's Rosengren in Boston. Right down the line, with a couple of exceptions. This is a Fed that's going to keep interest rates extraordinarily low for quite some time to come. In fact, I joke, at some point there'll be a meeting and they'll have an announcement and they'll state that the Fed funds rate will be at 0 for the rest of our lives. I can anticipate that announcement coming from the Fed. They will continue, I think, to anger many politicians who feel that the Fed is complicit with the run-up in deficit by keeping rates this low. But you talk to people over there, and they are genuinely sanguine on inflation. And I would agree that unit labor costs are tranquil, that there's no immediate inflation threat. Obviously, food and fuel are volatile. Metals can be volatile. But I think the inflation rate will stay pretty well contained, and the Fed will stay pretty accommodative for quite a while. I think a major reason why the Fed is accommodative is that we're looking at a very mediocre GDP rate, maybe 2%, 1.5% to 2% for the next 2 or 3 quarters. Very unlikely we could see economic growth stronger than that. We could see it a little bit weaker than that. And I think a key reason is going to bring us now to the second big point I want to talk about. A key reason this economy is so stagnant is the fiscal cliff. Now, and even though the fiscal cliff hasn't occurred yet, it would be the end of the year before things really look dire. I would argue that U.S. corporations, which are sitting on a ton of excess cash, are not spending, they're not hiring, they're not buying new equipment because they don't know what tax policy will be at the beginning of next year. This is crazy. This is not a good way to run a railroad, to have this type of uncertainty on tax policy, yet there we have it on the fiscal cliff. I would say at the outset on the fiscal cliff that in my entire career I've never seen a Congress as inept and constipated and gridlocked as the Congress we see right now. You talk to people, and the majority of members of Congress, I think, are not sufficiently aware of what would happen if we do hit the fiscal cliff. It could be very negative for the economy, but you talk to them and they tell you they would rather wait until after the election and use the fiscal cliff for their best sound bites to use against the other party. This is still viewed as a political issue to gain points on the other guy, the other gal, rather than something they should be resolving. It's very frustrating to see this up close. So what's going to happen? I would argue that, first of all, nothing will happen before the election. They just came back after a 5-week break. They're going out later this week until after the election. They come back for 2 days after the election, and then they take a 2-week break for Thanksgiving. Nice work if you can get it. So my sense is that we really won't get anything seriously done until December on this fiscal cliff. So I thought I'd break down this evening the key elements of the fiscal cliff and quickly go through the 5 big parts of it. Because everybody talks about the fiscal cliff, but some people, I think justifiably, don't really appreciate what those elements are that have to be addressed. There are 2 things of the 5 that I think could be done in December. One is the so-called tax extenders bill, which we get every year. I'm sure there are CPAs in the audience tonight. My friends at TruePoint all know that you have every year an almost an automatic extension of the alternative minimum tax, the AMT break, that keeps millions of Americans out of the AMT. There's also in the temporary extension bill, bonus depreciation, a big deal for businesses, the R&D tax credit. I think all of that can get done in December. The issue, of course, is how do you pay for it? And my suspicion is that the gridlock that persists over how you pay for stuff may lead to them doing this tax bill but not paying for it. The second issue that probably will get done in December is the so-called doc fix. And I'm sure there are doctors in the audience tonight who know that every year Medicare has an annual increase, medical payments, and I think they'll get that done in December as well. The trick on that is how do you pay for it? And again, I think they may not pay for it. But you're left then with 3 big issues that are at the core of the fiscal cliff that have to be addressed this winter. The first one looks a little different in just in the last couple of weeks. We had all thought that we would have still another fight on the debt ceiling. You remember what happened last July and August, this debacle where we talked about a government default, we got a credit rating downgrade from S&P. Well, they extended the debt ceiling, we thought, until December. But lo and behold, receipt growth is a little stronger than expected. Most people think there could be a surge of capital gains receipts in the 4th quarter. I'll get to that in a second when we talk about capital gains. So maybe we don't hit the debt ceiling until February or March. And if Congress has an excuse to delay action, they'll do it. So maybe the debt ceiling fight gets deferred. So now we're down to two issues still left on the fiscal cliff. One is so-called sequestration. What that means in English is that since the debt committee failed last November to come up with any debt reduction, as all debt committees fail, they now have mandated cuts starting in January, $106 billion, half on defense, half on domestic spending. Well, I can tell you right now, defense will not take a hit, zero. Defense stocks have done well this year, I think with good reason. And I think even domestic spending may get let off the hook because it looks like they'll come up with offsets. They'll come up with ways to avoid any sequestration. So you might be saying, well, what's the problem? So far I've explained 4 of the 5, and they look like they're not an imminent threat. But then we're left with the 5th. The big one, obviously, is what do you do with the Bush tax cuts? If they are not extended, we wake up on January 1 with more than just a New Year's Eve hangover. We wake up on January 1 with the top rate going from 35 back to 39.6. We wake up on January 1 with the cap gains rate going from 15 to 20, plus 3.8. Don't forget the 3.8 that's part of the Obamacare law that the Supreme Court upheld. We wake up on January 1 with the dividend tax going from 15 to ordinary income, 39.6 plus 3.8. We wake up on January 1 with the estate tax exemption going from $5 million all the way back to $1 million. These are pretty dire things. I don't think these things are going to happen in that magnitude, but that's the risk if they do nothing. So what's going to happen? Well, 2 scenarios, and not surprisingly, they depend on who wins the election. If Romney wins, he's made it quite clear he would prefer Congress do nothing and wait until after his inauguration, which would be on January 20. And believe me, if you tell Congress to do nothing, they can accommodate that request very easily. So I think that would happen. We'd get it resolved at some point in late January, early February. If Obama wins, I'm convinced that once again, he will try for this very ambitious, sure-to-fail, grand compromise. And what's the word? Quixotic? This quixotic, tilting at windmills effort that he always wants to see some big compromise, like Simpson-Bowles. Well, I know Simpson and I know Bowles, and they're great Americans, and they have some very good ideas, but a major point I would like to leave with you tonight is that we will never get the tax hikes of the magnitude that Simpson-Bowles want, $1 trillion in tax hikes over the next 10 years, with the current makeup of the House. There is no way that John Boehner and Eric Cantor and Paul Ryan in the House would agree to any tax hike of that magnitude. So my suspicion is, if the president tries this again, on Friday, December 21st, or Saturday, December 22nd, they'll break up in acrimony and say, gotta go, time for the holidays. We'll do what Washington does best, and that is kick the can down the road until the end of the first quarter. So we go through this BS all over again in February and March with still no certainty for corporate America, for individual taxpayers on just what is going to happen on fiscal policy. This kick the can down the road scenario, I think, is quite likely. So ultimately, I would agree with most people in the markets who feel that the final deal would not be particularly onerous. It would be fairly benign. There will be some reduction in GDP because the payroll tax cut will go away. I don't think they're going to extend that. There will be some spending cuts, but I do not see the dividend tax going all the way to ordinary income. I don't see the estate tax exemption going back to $1 million. Even most Democrats don't agree with that. Ultimately, they'll cut a deal. The issue is when, and that raises one final point I would make, and that is this lack of certainty. I cannot state strongly enough that as we get into late 2012, there will still be a total lack of certainty on what's going to happen to taxes. And the best way I can explain it is an anecdote. I did a speech like this a few months ago to a high net worth group of clients, a nice group like this, and this old timer, probably 85 years old, came up to me and he said, "Young man," and I love it when anybody says young man. I was very pleased to hear that. He said, "Young man, I've got all these gains I've locked in over the last 30 years. They're way in the black. I'm thinking of selling. Should I sell in October or November at 15% capital gains, or can I wait until 2013 or 2014? And I could not answer him. I do this for a living. And I could not answer him with certainty that the cap gains rate would stay at 15. I do have to respect that 3.8. I think that 3.8 is not going to go away. So what if you multiply this old guy by 7 or 8 or 9 million Americans who are in the same boat, thinking about their capital gains consequences as we get close to the end of the year? So I think that element of uncertainty has been overlooked. I think the markets are a little too sanguine on the impact of the fiscal cliff when you look at this anecdote I had with this gentleman. Well, when I look at the fiscal cliff and all of the complexities, people will say to me, well, won't the election solve everything? Won't the elections be cathartic? Won't the voters give the politicians in Washington a clear sense of direction? Moving to the third theme, I would argue that the sense of gridlock and dysfunction could actually increase after this election. This election is going to be so close that you could see even more dysfunction with a gridlocked city. Let me start with the presidential, and I do want to spend time on Congress, because I think there's a high likelihood Congress could get even more conservative than it is right now. On the presidential race, I make a sports analogy that it could be like a game where the lead keeps going back and forth, ups and downs, mood swings. Maybe the team that has the ball in the last play wins. It's going to be that close. I think it could be almost as close as 2000, hopefully without hanging chads in Broward County, Florida. But I think it's going to be a very close race. And when I look at it, well, first of all, I told everybody who would listen in the spring that Mitt Romney was the favorite. I thought he masterfully unified the party. He diffused any threat from Ron Paul and the Tea Party. He diffused any threat from Santorum and the religious right. He unified the party. And then something happened in June and July that I don't understand. And all of us who follow politics, people like Charlie Cook, who's a good friend and maybe the best in town in doing this, we all couldn't figure out that the Romney campaign did not hit back aggressively after a month or so of just relentless negative ads that you guys all saw living where you do. And I saw them all because I live next to a swing state, Virginia, and whenever I watched my beloved Washington Nationals, best team in baseball, between, I know that's controversial, but between innings I saw all the negative ads too. And during this stretch, a crucial period where you define a new candidate, I thought Romney got defined by Obama's people, and he was defined as Gordon Gekko. You know, someone who didn't pay taxes, someone who laid people off, blah, blah, blah. And the Romney counter-assault was weak, in my opinion. He hadn't PAC money that he could have used. And many of us who follow this noted that in all the key states, including Ohio, Romney's negatives went up after this relentless barrage of negative ads. And I told you I was a cynic at the beginning, and I'll tell you, the way you win an election, almost always, it rarely doesn't come true, is to drive the other guy or other gal's negatives higher than yours. Whoever has the higher negatives almost always loses. So that was the strategy. It worked. The negatives went way up. So here we are now in mid-September, and I think you've got to say, and again, I'm not saying this because I want this to happen, but I think you've got to say Obama is the slight favorite. I'll tell you how I still think Romney can win, but I think Obama is the slight favorite largely for two reasons. The first is, as most anyone, including Karl Rove, would tell you, it's a little easier for Obama to get to 270. The math is a little bit simpler. The paths are easier for Obama. Most people, including Karl, would put the total at about 230 right now for Obama. You only need 40 more. And if Ohio, which seems to be slightly leaning toward Obama, is put into that mix, well, that's 18. You're getting awfully close to 270. That doesn't mean Romney can't win, but there is no margin of error for Romney to get to 270. He has to win Virginia, he has to win North Carolina, and most importantly, he has to win Florida. Let me digress for 1 second and talk about Paul Ryan in the context of Florida. I know Paul Ryan. I like him. I've done TV with him. He's a good guy. He's talking about issues that have to be addressed in this country. But that Saturday morning, when they announced Paul Ryan, my initial reaction was the same. I have not changed it one iota. My initial reaction was, this makes it tougher for them to win Florida. And you got to win. That's the name of the game, even though Ryan is a very intriguing guy ideologically. Why does it make it tougher in Florida? Because he scares my mother. I call my mother in New England, and when Ryan came out with his plan, my mother called me up, and she said, Paul Ryan's going to cut my Medicare. I said, Mom, for Christ's sake, you're 88 years old. Nobody's going to cut your Medicare. And I walked her through the Ryan plan and talked about how it's for people under the age of 55 and how Ryan would save Medicare and, you know, things have to be done. And she listened to me and paused and said, Ryan's going to cut my Medicare. So my mother doesn't live in Florida, but there are so many people of her generation who went, not all, but who went through the Depression, who love Social Security and Medicare and don't want it to be tampered with. And I said that Saturday morning, and lo and behold, here we are with Romney still trailing in Florida. And I'll just flat out make this statement, and you can remind me if I'm wrong, but if Romney loses Florida, he cannot win the general election. The math is almost impossible with a state that has 29 electoral college votes if he were to lose that state. So, point number one, I think the path is a little easier for Obama to get to 270. The second reason is demographics. And I just point to two big factors. Number one is the gender gap, which is huge and actually widened after the pick of Ryan. Ryan is very conservative on social issues. I'm certainly not going to get into that tonight. But the fact is the gap widened by a couple of points of support from women for the Obama ticket. The more important story, I think, demographically, is Hispanic voters. The fastest growing demographic in America, if you talk to Rove, who's persuaded George W. to be fairly liberal on immigration. Rove is no fool. Rove knows you have to have inroads with that group. Obama won 67% of the Hispanic vote 4 years ago, and I've talked to people in this campaign who think he can win 70% of the Hispanic vote. I watched all 20 of the Republican debates, and as I watched some of them, I just said, wow, are they going to try to antagonize every Hispanic voter in America? They almost did. And I think that that's a big, big factor in a state like Colorado, 9 votes, Nevada, 6 votes. So it could be 2 a.m. on election night, and we're waiting for the returns from those states. And I think that the Hispanic vote could be enough to tilt the scales. And there's one other factor in states like Colorado and Nevada that nobody is talking about. That involves a fellow by the name of Gary Johnson. Anyone heard of Gary Johnson? He is the Libertarian candidate, former governor of New Mexico. He's polling 10% in Colorado. And I would argue that if he even got 5% in Colorado, and he's nearly got an endorsement from Ron Paul, that 5% would be taken largely out of Romney's hide. So to me, it's a little easier for Obama to get reelected. Certainly not a shoo-in. And is there a path for Romney? Well, absolutely. I think that he's got more money. His ads have gotten a lot tougher. There are a lot of things that I think could still break his way, the Mideast, for example. It's not been a good last couple of days for him. I've been out of town. I haven't talked to all my sources, but my sense is that Romney talked about an issue that many people discuss, that we have a big chunk of Americans who don't pay federal income tax. I understand that, but he might not be the best messenger to talk about that. Maybe, if you live in glass houses, I think maybe Ryan would have been a better messenger, John Boehner. Many people who I respect do talk about 47% of all Americans who don't pay taxes, but Romney even admitted he said it in an unartful way. Most importantly, what happened this week is that Romney has squandered 2 or 3 days, because this will dominate the news for 2 or 3 days. And I won't get into who's right, who's wrong, but those are 3 precious days in which he is not talking about the economy and jobs. That's the name of the game, and he's not going to be able to talk about that. I think the key, though, if you hope that he would win, obviously are the debates. I think that it starts on October 3rd. I think there's a high likelihood that he will exceed low expectations. I always have argued the key to my career was exceeding low expectations. And I look at the debate between George W. and Al Gore. Everyone said, oh, George W., he can't even make a subject and verb agree. He's going to get killed. Well, guess what? George W. won against Al Gore in that debate. He beat him decisively. And I think there's a potential. Again, as someone who watched all 20 debates, I thought that Romney was quick, he was funny, he had some personality. I think Romney will surprise in those debates, and that may be a factor. Bottom line, two things that I want to talk about the congressional election. Bottom line still to me is that Romney and the Republicans have made a compelling case to fire Obama. I don't think there's any question. But they have not made a compelling case to hire Romney. They've only got half the equation done. They still have time to make a compelling case to hire him, but they haven't done it, in my opinion. They haven't done it yet. One other point I want to make, and that is, I think this election will be unusually difficult for the poll takers. You talk to people in the polling business, and they will tell you off the record that there's a lot of stuff they're not sure of. How much do you weight people who have cell phones versus landlines when you make the calls? How many African Americans do you put into your mix? How many likely voters as opposed to registered voters? And by the way, how do you define a likely voter? How do you know for sure? There are so many variables in the polling business that I'm a little dubious. Rasmussen usually leans toward the Republicans. The New York Times leans toward the Democrats. What I look at, if you guys are political junkies like me, what I look at every day or so is Real Clear Politics, nice website, and they have the weighted average of every poll out there. Right now it's got Obama ahead by 3, which feels about right. That's close to the statistical margin of error. I'd look at their poll more than any other one poll. Final thing I'd say. My good friend Charlie Cook says that what he looks at more than anything else is the Gallup overnight job approval rating. And again, if you're a political junkie and you want to tune in every day, at 1 p.m. in the East, they change their number from their overnight rating. It's in the upper right-hand corner. It's a free website, www.gallup.com. And Charlie says if Obama's job approval rating is above 50, he'll probably win. If it's below 45, he'll probably lose. During much of the spring, I thought Obama had a terrible spring. He was at 45, 46, 47. The last week or so, he's been at 49, 50, 51. He has moved up a bit on that very, very key indicator. Well, what happens if he wins? Does this mean for the markets and investors we return to an activist agenda, that we have the concern about some new move toward the left? I would argue that the other big story is the congressional elections this fall. And I think the Republicans will do quite well. First of all, the House. That's an easy call. The magic number is 25. There's no way the Democrats can get to 25. They could get 6 or 8 or 10, but I think 25 is out of the question. So a year from tonight, John Boehner will still be the Speaker of the House, always looking over his shoulder for Eric Cantor, who is probably the most ruthlessly ambitious politician I've ever met in my entire career in Washington. The Senate is the more interesting story, where the Republicans almost certainly will get gains, but now it's looking like they might not get the net of 4 that they were hoping for to take the Senate. They will get some seats because of this very unusual mix this year. Of the 33 seats, only 10 are held by Republicans. And I think they'll lose the main seat, Olympia Snowe. They may not lose another, although things now are starting to look a lot closer in Massachusetts, where the Native American Elizabeth Warren is slightly ahead of is slightly ahead of Scott Brown. But even if the Republicans hold on to all but that one seat, the main seat, I think the Democrats may be able to just barely get enough to keep the Senate by a seat or so in control of the Democrats. The most interesting story in the Senate is this, that many of the new Republicans are going to be Tea Party Republicans. So for Mitch McConnell, he'll get more Republicans. That's the blessing. The curse is a lot of them will be well to his right. Example, Texas, Ted Cruz, Tea Party conservative, will replace Kay Bailey Hutchison, moderate Republican. Up in Indiana, I think Murdoch will probably win and replace, of course, Dick Lugar. In Indiana, in Nebraska, there'll be a Tea Party member. So it'll be a very conservative Senate, and it's worth noting that many of the real adults who like to compromise are leaving. Olympia Snowe, Joe Lieberman's leaving, Lugar got defeated, Ben Nelson's leaving. So I think you will have a more polarized climate. So if Obama does win a second term, I think you'd have more gridlock. You'd have maybe something similar to the second Bill Clinton term, with both houses controlled by Republicans. Not a lot got done. I say it could be like Bill Clinton's last 4 years, except maybe without the interns. So I think that was a cheap shot. I'm sorry, that was a cheap shot. So I think so when people say, well, we're not going to get deficit reduction next year, we're not going to have real progress on these issues, my answer is quite simple. And again, I'm a cynic. How can you get members of Congress to pass a deficit deal with interest rates this low? You need to have an angry market, bond market vigilantes saying, for God's sake, could you guys get your act together and do something? But no, the Treasury 10-year bond yield is under 2%. How are you going to get these people motivated? You can't even get them to reform the post office right now. And I'm not being facetious. A lot of Tea Party members came to Washington. By God, we're going to really cut the deficit. They can't reform the post office because members of Congress are afraid of angry emails and phone calls from constituents in their home districts where post offices will be closed. How are you going to reform entitlements if you can't reform the post office? So I'm not optimistic that we're going to get a big tax reform bill. We're going to get big entitlement reform. This could come down the road, but I don't think it's imminent. I think we probably just have gridlock until the markets say enough is enough. You know, we're maybe not next in line after Europe, after Italy, Greece, Spain, Cyprus, but we're a ways away before the markets say enough is enough. And the only way you can get these people to move is if a crisis is imminent, in my opinion. So I would just make a quick comment on what might happen if Romney wins. Never in my career have I seen a mix like the mix I see right now among my clients. My clients are big institutional investors. They're people like you. When I travel around the country, I'm struck that maybe the mix is 80-20 for Romney. I've never seen anything like it in my career. 4 years ago, it was pretty close to 50-50. I think a lot of people were tired after 8 years of Bush. It was a lot closer. But now you have people like Jamie Dimon and everybody in the industry all moving to the other side. And I would have to say, even though I try to stay on the 50-yard line, that a Romney win, I think at least initially would be encouraging, that it would give us some sense of predictability on taxes. It would give us some sense that somebody in charge really knew how the economy worked. But I do point out to all of my clients and friends, there are two things that I worry a little bit about if Romney won. The first is the stridency of his rhetoric toward China, prompting even the Wall Street Journal editorial page last weekend to tell him to cool it. He's basically promising a trade war. I'd be the first to agree the Chinese don't play fair on currencies, on trade, the way they treat their dissidents, but do we really want to antagonize the Chinese? I mean, the last time I checked, they buy a bit of our paper. So I think that's one thing the markets might not look forward to if we had a real trade dispute with the Chinese. And the Wall Street Journal editorial page crowd is a very free trade crowd, and they have an issue with Romney on that. The other thing I'd be concerned about, and some people don't agree with this, but it's my strong opinion, that whenever you have politicians really telling the Fed what to do, I get worried. Well, I mean, these guys have done such a great job on fiscal policy. They're going to get involved in monetary policy now. And whether it's on the left with Barney Frank or on the right with Ron Paul, when I hear politicians saying we're going to tell the Fed what to do, I think the markets get a little worried about that. And I understand Romney would like his own person. Bernanke's term expires in January of 14, not January of 13. I think he would like Glenn Hubbard or Marty Feldstein or Greg Mankiw, and I think that will occur. But I think for a new president, if Romney were to win, to have one of his first acts a nasty dispute with a Fed chief is probably something the markets would not like to see. So there are some things to worry about, but I would say in general that a Romney win would be very, very well received by the markets. Well, let me finish with just one theme, and I've always argued, as some of my friends here know, that we overlook geopolitics at our own peril. It's the great wild card, and not just as investors, but all of us as citizens of the world. And we got a reminder, as if this country needed a reminder. We got a reminder a week or so ago of the types of people out there who would like to kill everybody in this room. And for us not to acknowledge that is just ridiculously naive. To see this crazed mob kill innocent people, and it happened, of course, right at the time of 9/11. And I was in a hotel room, as I often am, flipping the dial around, and I couldn't turn my eyes away from, they had, the History Channel had a special that many of you have seen, no narration, just an ongoing narrative with a camera on what happened on 9/11. I was there. I was supposed to be there. I was running late. I had the world's longest morning conference call, so I was running late and was not there. And I've seen this, but I saw it again, and I thought of the ambassador and people in the embassy were killed. And I just thought, we are so naive. If we're going to spend most of our time focusing on the Kardashian girls or, Britney Spears, for Christ's sake. I mean, there are people out there who would love to kill all of us. Which brings me to the most serious issue of all. More serious than the fiscal cliff or the election or the Federal Reserve, and that, of course, is Israel-Iran. That's the big one. And I must tell you, in the last couple of months, there's been a really dramatic shift in the rhetoric surrounding Israel-Iran. For years, everyone, including myself, said, will Netanyahu move? The question was whether Netanyahu would move. In the last couple of months, the question is, when will Netanyahu move? That's a really, really big change. People are speculating, could it be before the election? I doubt it. He's personal friends with Romney, and I think Netanyahu knows that a big crisis usually favors the incumbent. Could it come between the election, November 6th, and the inauguration day, Jan 20? Yeah, it could. I was at a conference 2 weeks ago, and one of the speakers right before me was a former head of the Joint Chiefs of Staff. And I won't mention his name because we talked off the record. But I said, General, when are the Israelis going to move? He said, this winter. I have a general on my staff, retired 3-star Marine general, and we asked him, and he's above 60% that the Israelis will move this winter. What's changed? Well, why could this happen? I'd say 2 things. Number one, the International Atomic Energy Agency, IAEA, has determined a really shocking increase in the amount of enriched uranium that's been processed by the Iranians. I think that you could make a convincing case that they're within half a year of having a dirty bomb. And that's the stuff that the inspectors could see. No one has gotten into these facilities near Qom in the mountains of Iran. The second thing that's changed is that the Iranians have totally rejected any kind of negotiation. I must admit, I thought naively that maybe we could have a negotiated settlement. A lot of people I respect thought during the summer we could get this. And they had talks in Moscow that totally collapsed. I think the Iranian Ayatollahs, who really control things, it's not Ahmadinejad, the Iranian Ayatollahs are delusional. They have no idea what threat they have to their own country. They're so delusional, they had a conference of non-aligned countries 2 weeks ago, and the head of Egypt had the courage to get up and rip into the Iranians for supporting Bashar al-Assad in Syria. The Iranians were stunned that anyone would have the temerity to even criticize them over Syria. The Iranians are despised throughout the Mideast for what they've done in Syria. They're hated by the Saudis and just about everyone else. And I would argue, if there's no meaningful negotiation in the next several months, I do think the Israelis are going to go in. It'll be messy. Both generals I've talked to said, well, this could be done in weeks rather than months. I hope they're right, but remember a lot of people saying we'd be greeted as liberators in Baghdad. So my BS detector gets a little acute when I hear people say this can just take weeks. We'll wrap this up quickly. But it is the great threat. It's, to me, the greatest threat that exists, despite all these other things that I've warned people about this evening. Let me just finish with one positive note after all of these very gloomy subjects that we have to talk about, and that is that it strikes me that once we get through the fiscal cliff, and we will, once Israel-Iran is resolved, and it will be, then I think that there will be a focus on a series of really dramatic stories, mostly in the U.S., that have been overlooked. We're close to being energy self-sufficient. Nobody even knows that. If you look at fracking, if you look at the Dakotas, that's a great, great story. You look at corporate balance sheets. Never in modern history have corporate balance sheets been this outstanding. Companies are just waiting to spend once they get clarity. You look at the housing market. I think with the exception of a pocket or two, the housing market clearly is bottom. And you look at state and local governments. You look at their spending levels, their receipt growth. There's only 2 delusional states left, California and Illinois. With the other 48 look pretty good, in my opinion. I think that story is going to continue to look better. So to me, there's a lot of reasons to be positive as we look into the spring and summer of 2013. But unfortunately, we got to get from here to there. And I would argue that the next few months could be a pretty bumpy ride for all of us. So I'm going to stop on that cheerful note. I'm going to bring Steve up, and I'll be back for questions. I'm looking forward to taking your questions a little later. Thank you.
Thank you very much, Greg. That was excellent, and I may just speak for myself, but thank God he ended on a positive note. So my job now, in the wake of that, is to sort of kick off the Q&A with a common investment-related question, particularly in the wake of everything that we just heard from Greg, because we certainly can understand investors being nervous with all of the uncertainty that's out there. But the one thing that we do know is that when you think about your investment portfolio and what action you might take, the one certainty is that fleeing from stocks is not a strategy, it's an impulse. So what we'd like to talk about today, that's a frequent question, is this big question. Should I reduce my exposure to stocks? I know I've gotten this question from a couple clients in the last few weeks, and my guess is at this point, there's a few people sitting in the audience today who'd be interested in asking the same thing. So the very first step, the most important step in addressing this question is to first and foremost examine the underlying reason for the possible change. So let's start there by asking, what are not sound reasons for reducing stock exposure? Number one, a gut feeling. So this applies just as well for me as it does to everyone else in the room. While our intuition may serve us well in many other areas of life, the research is clear that when it comes to the financial markets, our natural human emotions work decidedly against us. Number two, fear of known issues with unknown outcomes. Now this at first can be a challenging concept to understand, but much of what Greg discussed fits into this category. So the fiscal cliff, the coming election, for example. These are issues that have uncertain outcomes, but are well known to investors. And as known issues, stock market prices already reflect an expected outcome. Now, this is a key point, so let me reiterate that. As known issues, stock market prices already reflect an expected outcome. For example, Greg had referred to the presidential election. Stock prices today are incorporating their expectations for that election. If the outcome ends up to be better than the market expected, prices will climb. If the outcome ends up to be worse than the market expected, prices may fall. But if the outcome ends up in line with expectations, you don't necessarily see an impact on market prices. Those expectations are embedded. So because of that, if as an individual investor, you choose to exit stocks, for example, what you're effectively doing is making a bet that your personal expectations for the future will ultimately prove to be more accurate than the expectations formed by the collective wisdom of all market participants. And this is why market timing is such a poor gamble, because it simply is not reasonable to think that any of us knows something that is not already reflected in market prices. 3, a belief that the stock market has reached a peak. Now, this is not an unreasonable feeling right now because the U.S. stock market is actually approaching our previous highs. But it's valuations that matter, not absolute market levels. And currently, stock valuations do not appear excessive. For example, second quarter earnings for the 500 largest companies in the U.S. set a historic high. In stark contrast, current bond yields are among the lowest in history. And as a result, bond returns going forward are likely to be depressed for many years. And in fact, it's the poor outlook for bonds that led us at TruePoint to reduce our investment return expectations that we utilize in long-term financial planning projections for our clients. So now that we've looked a little bit at the reasons maybe that are not as sound to make a change in the portfolio, let's flip the equation and look at the other side. So what are sound reasons for reducing stock exposure? Number one, your move from the contribution phase to the withdrawal phase is in sight. So for most of us, this would coincide with retirement, when you move from adding to the portfolio to withdrawing from the portfolio. Now, as you approach retirement, the allocation of the portfolio should be revisited. But whether it's advisable to make a change will really boil down to two factors: time horizon and cash flow needs. So the review should occur, but a change isn't necessarily automatic. Two, your asset level is substantial relative to your anticipated spending needs. So by way of example, let's say you have a 30-year time horizon, and the annual withdrawals you need from your portfolio represent less than 4% of your portfolio value. You're in the fortunate position of having enough flexibility where you may be able to move to a more conservative portfolio. Number three, your time horizon for the assets is meaningfully less than when the allocation was originally adopted. So simply put, as time horizon declines, so does the need for the growth of the assets. And number four, you're willing to reduce spending in exchange for a less volatile portfolio. Risk and return are forever related. Any reduction in market risk translates into a reduction in the expected return of the portfolio, which means there'll be less available for spending likely. Question is this a trade-off you're willing to make? If you look at the four sound reasons, the one thing that should stand out is every one of them is about you and your circumstances, not about the financial markets. What the evidence shows us and what experience shows us is that altering your portfolio in reaction to or in anticipation of market events is typically a losing proposition. We're in an industry that's built on the premise that stock picking and market timing add value. Our disciplined buy, hold, and rebalance approach seems like blasphemy in the face of that. But the academic evidence is overwhelming, and the practical results are clear. If ever there was a period of time where the ability of an active money manager to add value, it was in the last 12 years as we experienced the most volatile and uncertain markets in a long period of time, back to the Great Depression. So the opportunity was there. Let's take a look at the results. What you see here are effectively the 12-year results for money managers focused on large cap U.S. stocks. So over a period just shy of 12 years, they produced a cumulative return of 20%. Now that's not a mistake, a cumulative return of 20%. In comparison, the Vanguard S&P 500 index, which literally buys 500 stocks and holds them, passively managed, produced a return of 32%. So even in an environment that was among the most volatile in history and delivered the worst stock return since the Great Depression, the very simple passive buy and hold approach meaningfully outperformed active managers. Let's look to the foreign markets. If we look at money managers that are operating in the developed markets outside of the US, over the same 12 years, the roller coaster ride was even a little more dramatic on the high side and on the low side. Ultimately, they did slightly better than the US managers, delivering a 24% return. In comparison, the Vanguard Foreign Developed Markets Index, again, a simple passive buy and hold strategy, outperformed, delivering a return of 33%. Now, in both cases here, we're looking primarily at large cap stocks, but any balanced portfolio should also hold high quality bonds and other stock categories like small cap, emerging market, real estate. So let's take a look at how a more broadly diversified portfolio performed. It delivered a cumulative return of 46%. So a meaningful improvement over the stock holdings simply by holding a more broadly diversified portfolio. Now, this balanced portfolio manager's performance number comes to us from Morningstar, and it represents all of the moderately allocated mutual funds out there. Actually, only those that survived the full 12-year period. Now, this effectively serves as the largest peer group for the portfolios that TruePoint manages on behalf of our clients. So it begs the question, how did our clients do on a net of fee basis? So the TruePoint 70/30 portfolios delivered a cumulative return of 79%. Now, this is all the clients in aggregate that have a 70% stock portfolio, which happens to be the most common allocation among our client group. As I alluded to earlier, the primary distinction between TruePoint's investment strategy and that of many of these peers boils down to stock picking and market timing. Most of our peers pursue one or both, while we believe in neither. And the overwhelming academic evidence and the practical experience reinforces those beliefs. So what I can tell you is you look at the outperformance that the TruePoint clients enjoyed relative to the peer group, it is not, emphasize, not a result of our ability to forecast the future. In fact, it's exactly the opposite. We fully recognize and accept that no one can accurately predict the future. The good news is, as evidenced by these results, predicting the future is not necessary for a successful investment experience. What is necessary is broad diversification, disciplined rebalancing, and a long-term view. And those things hold true regardless of the uncertainty that we face. With that, I'd like to invite Michael and Greg to join me on stage for the remainder of the Q&A.
Okay, I'm going to get us started here with a question to Greg.
Sure.
You mentioned that with the Supreme Court upholding the Obamacare plan, that essentially that plan is in motion. So what would happen if we had a change in Congress? What kind of expectations could we see as a result of a more conservative group there?
If Romney were to win, I think he would take the Senate with him. And if that happened, I think they would overturn just about all of the Obama health law. Romney confused a lot of people a couple of weeks ago when he said, well, there's parts of Obamacare I like. And a lot of people on the base said, we didn't hear you say that in Iowa. So it raised some eyebrows. But I do think at the end of the day, if he wins, he could probably do it with just 50 or 51 votes, not 60, a filibuster-proof vote, because it's not technically a tax issue. So I don't think. The Supreme Court might disagree. But no, I think there's a good chance it would be overturned if Romney won. If Romney loses, I think Obamacare really grows some roots and is going to be very hard to uproot.
I've got another question here, Greg, that focuses on key political appointees.
Yep.
So what do you envision for individuals like Hillary Clinton, Tim Geithner, Ben Bernanke that are in key political positions today?
Sure. There's no question Hillary will resign by Thanksgiving. She's tired. She's worked pretty hard. She's traveled around the world, and she wants to take a break and write a book and decide whether she wants to run in 4 years. My suspicion is Bill would prefer her to run more than she would prefer to run, but I think there's still a chance that she might. There's two candidates to replace her. One would be Susan Rice, who was the UN ambassador, who was on the talk shows this weekend. She's a pleasant woman, but I didn't think she did a persuasive job in defending the administration case. The other name is John Kerry, and John Kerry's the head of the Foreign Relations Committee, and I think he would be on the short list to replace her. Geithner is definitely going. A lot of names floating around. The most intriguing name to me, and this will be a litmus test to see if this president wants to become more of a pragmatist, more of a moderate in his second term, and that would be if he considers Erskine Bowles, a moderate Democrat, Simpson Bowles, North Carolina, a guy who is hardly a liberal flamethrower. If the president appoints Erskine Bowles, that would be a real signal to the markets that he would try to at least offer some olive branch.
I have another question here that there may be a view behind this, but the question is, how does the media benefit from leaning to the left? And what will it take to turn that bias to reality?
It's not going to change, I don't think. I mean, the press, I know I have a lot of friends in the press, and just as my friends in the investment community are maybe 80-20 in favor of Romney, I'd say my friends in the press are 80-20 in favor of Obama. That's just a fact. I think the press likes a hot story more than anything else, as they proved with Bill Clinton. I mean, they treated him pretty harshly. But, you talk to reporters, many of them that I talk to feel that Obama is aloof and not a particularly good politician. I think most reporters would agree that he lacks the political skill set that a Ronald Reagan or a Bill Clinton or an LBJ had, knowing how to really expend political capital. So the love affair between the press and Obama has faded a bit, but let's be honest. I mean, the press, again, I think it's 80-20, and I think it's just something you have to accept. There are big exceptions like Fox and the Wall Street Journal. I mean, it's not monolithic, but I don't see any big change in the media treatment of politics. By and large, the media, the Washington media, is quite liberal.
Steve, I have a question for Greg. Greg, it seems as though our two-party system is certainly polarized, and the dysfunction, as you've described, has probably never been greater. I know that a lot of folks would love to see someone that really speaks for the country. Do you see a party or a candidate that comes out in the future that finds the middle ground?
You'd love to think that would happen. Michael Bloomberg intrigues a lot of people, and as I joke, he has 22 billion reasons to run at some point. But he's so much of an activist on junk soda, on gun control. He's way to the left on gun control. I can't see him doing well in much of America with the views that he has. The one politician who does intrigue me, if he can win in Massachusetts, is Scott Brown. Very articulate, likable guy who could bridge the gap between the two parties. I think if Scott Brown wins, he'll be a really interesting, dynamic player for at least 6 more years.
I've got a straightforward question here for you, Greg. Do you think Mitch should release his tax returns?
Well, McCain released 2 years of tax returns. I don't think there's no legal requirement for him to do so. My own personal opinion is that he's done nothing illegal. Does he have exemptions that he would prefer not to disclose? Absolutely. I mean, the 1 year or 2 years that he has released, no, he's only released one. The next year is coming in a week or so. I mean, he did have a $70,000 write-off for that dancing horse in the Olympics. So, he probably doesn't want to have a lot of scrutiny on his releases. Let me just say this. If we're in a world now of WikiLeaks where everything can be hacked into, do you think maybe on October 29th or October 27th, somebody's going to hack into Romney's tax records and just accidentally release them to the New York Times? I don't rule out that these records will somehow become public. because that's the way the world is now. Things get hacked all the time. But no, I don't think he has to. There's no compelling reason why he does. You know, to me, I'm old enough. There's some people in the room who remember Joe McCarthy. I think Harry Reid has sounded like Joe McCarthy. It's just attack by insinuation without any proof that Harry Reid has that Romney didn't pay his taxes. I'd like Harry Reid to either put up or shut up on that, and he hasn't.
I have a question here that for Michael and I. Michael, I'll let you take the first stab. Can you speak to the financial results of TruePoint?
Yeah. You know, TruePoint, you know, we have been able to manage our growth. You know, over the years when we had the big downturn in 2008 and going into 2009, we've been able to adjust our workforce, the folks that we bring on. We have been able to adjust our spending in a number of other ways, and you know, fortunately, you know, we were able to get through that time frame in a way that we were able to keep, you know, a good majority of our team intact, and we have been careful about the folks that we bring in going forward. One of the ways we structure our compensations is to split between you know, a base salary and a variable compensation package, and it allows us to smooth out some of the bumps. But we did make you know, a couple adjustments in the ways that we you know, charge our fees, and we are now in a position today that we think you know, is sustainable for the future. So you know, I feel good about the long-term viability of our organization. You know, I feel good about the kind of leadership team that we have put together. We're planning to add new partners to our group next year, and you know, I think the outlook for TruePoint is, you know, financially solid. And you know, again, we couldn't do that without the outstanding you know, I guess loyalty and actually the kind of the client expectations and exceeding the expectations that you've had for our firm and our advisors. So it's really a thank you to both our clients and to all the advisors that are serving our clients.
Yeah, and the question referenced the annual report as well, which if you haven't seen that yet, please grab a copy. We do try to make as much information available in there as we can, and that's one of the steps that we take. We are big believers in transparency with our clients, so one of the things we do, even as a private organization, is try to share as much as we can with clients. But a couple of specific measurements that we measure ourselves by in terms of our financial operation is we want to operate at average levels, essentially, within our industry in terms of profits. And the reason for that is two focus areas. One is we always want to feel like the value that we bring to clients is clear. And historically, we've operated at fee levels that typically are below industry averages. And that's one of the ways we feel like our partnership with clients is a true win-win. But what we have to be sensitive to as well is we have to be able to continue to recruit and retain the top professionals in the industry. So we have to make sure we have an environment that allows us to do that. And fortunately, I think we've been able to strike that balance. Another question for you, Greg. Do you envision the U.S. truly reducing its dependency on foreign oil? You referenced this earlier.
I do. I think it's one of the least appreciated stories out there. And I think that the innovation that's going on, especially with gas and oil exploration within the U.S., will continue. So I think that's one of the really good stories out there, and I think that will persist. Wouldn't it be wonderful if someday we didn't have to be so involved with the Middle East because we're not as addicted to their oil?
Do you think that there is a time frame over which that would happen, or will it vary based on the outcome of the coming elections?
I think probably if Romney won, there would be a more aggressive program of drilling and exploration. I think, though, even if Obama wins, I think we'll get Keystone eventually. I never understood Keystone. Why do you want to antagonize organized labor, as Obama did? I mean, where are the environmentalists going to go? They're going to vote for him anyway. So I never understood Keystone. But I do think that under Romney, you'd probably see a more aggressive drilling and exploration program, yeah. And less chance of a punitive tax hit on the industry if it was Romney.
One question that I'll address real quickly is a question came in asking about the increase in the foreign allocation in portfolios that we talked about with clients at the beginning of the year, a marginal increase primarily to emerging markets in the foreign portfolios. And to date, the U.S. markets are up, depending on the category, 15 to 20%. The foreign markets through the most recent week are up 10 to 15%. So U.S. markets year to date outperforming. But of course, the rationale for having any international allocation in the portfolio, frankly, is risk reduction. It's essentially, if you look historically at what's the best balance between U.S. and international stocks for minimizing risk in the portfolio, it's roughly at about a 60% U.S., 40% foreign combination, and that's approximately where we are in our portfolios, and the expectation is over time that will allow for very similar returns at a lower level of risk. And sort of related to that point, a question for you, Greg, as we get ready to wrap up here. Internationally, how would the election of Romney versus the election of Obama be viewed by our foreign partners or even adversaries?
Well, it's a big issue right now. And let me just go back to one thing. I need to compliment you in talking about your investment strategy, because I can warn all of you of things that could happen geopolitically. But it's worth noting that within months of 9/11, the market and the economy were stronger. Within 2 weeks of the S&P credit rating downgrade, the market was stronger than before the downgrade. So a lot of these events that sound dire are events that shouldn't necessarily prompt people to act hastily. And I thought your comments were very, very well justified in what you said. I think that, to me, when I heard some Romney supporters say last week, well, if Mitt Romney were elected, we wouldn't have rioting in the streets of the Middle East. Come on. I mean, I don't think you're going to be able to control things like that. It's so unpredictable. I think that at the end of the day, what you need to see is more consistency. And I saw very little consistency from either party on the Arab Spring. Everybody was all over the lot. Gingrich said one thing, Obama said one thing, Hillary said another thing. I think you need to have more predictability on foreign policy. But let me just say one other thing. I still think at the end of the day, the U.S. remains the ultimate safe haven for investors. And people say to me, well, what if the Chinese get out of our markets? What would happen then? The Chinese aren't going to get out of our bond market. They would ruin their own portfolio. They own so much of our debt now, that would be ludicrous for them to hurt their own investments. And besides, you would ask the question, they would go where? Is there an investment compellingly better than the U.S.? You want to go to Western Europe, where the #1 name now for baby boys in every hospital in Western Europe is Mohammed? Good luck. You want to go to Western Europe? I still see the U.S., maybe by default, but I still see, despite the problems out there, I still see the U.S. as continuing to be the ultimate safe haven for investment.
I know we're right up against the concluding time. Before we wrap up, Michael, any final comments from you?
Now, as I mentioned before, I just wanted to thank clients again for your continued trust and confidence in TruePoint. I want to thank, again, all the members of the TruePoint team for the work that they do to make those experiences for our clients so great. I want to thank our marketing department in particular for helping us get this program off without a glitch. And I want to thank Vanguard for sponsoring Greg's attendance today. I should also make a quick note. I'm thankful for the folks from Fidelity, our great custodian, for making the journals available for us. We really appreciate that. And Steve, you did a nice job. So thank you, everyone, and we'll see you in the routine.
Okay. Good deal.